I think we're in that transition from macro crypto spring into macro crypto summer. The transition here is usually when the forces are still disinflationary and growth is slow to picking up. That is like macro utopia. That tends to push the central banks and the governments to adding liquidity. So the crypto summer starts around now. It also forms the basis of the banana zone, and that's when things start to get really crazy. So that's where we are in the cycle now. So we're just in that zone of, we've got this beautiful chart pattern that is just consolidating. It's only a matter of time now before we start to see the next move. And that's also likely to coincide with some other liquidity.
Raoul Pal begins by discussing the transition from what he terms macro crypto spring into macro crypto summer. He clarifies that this isn't tied to the actual seasons, but rather to phases in the liquidity cycle that drive asset prices. This transitional phase is marked by disinflationary forces and slow growth that begins to pick up. According to Pal, this environment is akin to a macro utopia because it prompts central banks and governments to inject liquidity into the economy. This period also coincides with the election cycle, during which politicians typically increase spending to gain favor with voters. Pal emphasizes the cyclical nature of liquidity and its impact on markets, coining terms like banana zone to describe periods of extreme market activity. The banana zone is a phase where market exuberance leads to significant price increases, reminiscent of the shape of a banana on a chart. This analogy underscores the predictable yet dramatic fluctuations in asset prices during these cycles. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think we're in that transition from macro crypto spring into macro crypto summer. Now, people confuse it with the actual season itself. I just saw that on Twitter. I'm like, no. It's because it breaks down to 4 periods of the liquidity cycle that drives assets. So the transition here is usually when the forces are still disinflationary and growth is slow to picking up. That is like macro utopia. Why? Because that tends to push the central banks into adding liquidity and the governments to adding liquidity. It also happens to be, this everything code cycle is also about the election cycle. And guess what politicians do at this time as well? They want to give candy to the kids. So they're stimulating as well and tend to stimulate into the following year as well. So that particular juncture of the macro starting to pick up, the ISM survey is still below 50, so it's still sluggish. The forward-looking indicators are all very positive, and liquidity has been positive for a while. That pickup, if you think of it, we've had a Wall Street recovery, which is liquidity. Main Street recovery is yet to happen. Main Street is when earnings go up, and all of our earnings go up, and there's a bit more money around. That's when the flows from all of these earnings start going into markets as well. So it's not just liquidity and debasement driving things, it gets driven by actual investment money, which has been actually quite lacking in many respects. So that's typical of the crypto summer. So the crypto summer starts around now. It also forms the basis of the banana zone. And that's when things start to get really crazy. If we go back and look at all of these, since about 2008, they've all done roughly the same thing, which is presidential election cycle. It kind of has a sell-off into the summer, then it tends to accelerate sideways over the election because everyone doesn't know what it means, and then it's all over, markets rip. Whatever the outcome, a shock, expected result doesn't matter. And so that election cycle has been very prevalent both in equities and in crypto. So that's where we are in the cycle now. So we're just in that zone of, we've got this beautiful chart pattern that is just consolidating. The stuff that has less network traction or network adoption has fallen significantly, but we're starting to see the recovery. So I think it's only a matter of time now before we start to see the next move. And that's also likely to coincide with some other liquidity things. I think the Japanese have to intervene with the blessing of the Fed, because that's going to help the Chinese, the Japanese, everybody's business cycle. That has to come. because the US dollar is far too strong for this point in the cycle. The other thing that needs to happen alongside that is the Fed absolutely have to cut. And I saw you talking on Twitter today. Look, inflation, the true inflation numbers at 1.82. Core CPI is now headed lower sharply, but rates are at 5.5. It makes no sense considering the lag that it has. If not, they're going to undershoot inflation, which I don't think they mind, because you can refi debt at lower levels, because they put everything at the short end right now. Janet Yellen's been issuing short end debt, so the lower she gets rates down, the more she can get back into the 4-year cycle. So Julian Battelle and myself kind of used the term actually for last quarter last year. We said, hey, listen, liquidity's picking up. The pre-election cycle, it usually goes bananas. And then so we called it Banana Zone. It was the front cover of Global Macro Investor was Banana Zone. And then we started realizing, you know what, the macro summer and macro fall or autumn, that's the massive banana zone. And then you see that beautiful chart of Bitcoin every cycle and it goes vertical. And you're like, well, it just looks like a banana. And the banana zone says everything. It goes bananas. It looks like a banana. It's funny because it's kind of phallic. It's memeable. And so, but as I said, that is the banana is the big yellow candle of our hopes and dreams is all carried into that. And that's the liquidity cycle, the everything code cycle. If you want to use the Bitcoin halving cycle, which I don't really do, but it's all the same thing. It's all there. And this is the point. And it's all held in that yellow fruit. I've explained there are two assets in a secular bull market, technology and crypto. Arguably crypto is technology, but that's it. So number go up the most. We've gone through the fastest period of change in technology in all human history. We've just brought into the world infinite human intelligence to the power of whatever. We don't even know to the power of what? The power of 10, the power of 100? We've just replaced humans by robotics. We've got cars that drive themselves. We're able to edit the human gene. We've got just La La Land stuff going on, the book of sci-fi novels. And these are companies with products. We're not even talking about them anymore. These are actually happening. And people want to invest in old stuff because, hey, it's cheap here. You're like, what are you missing? Do you really think anybody cares about your gold mine? Really, when you've got what's going on? Now, that doesn't mean all these stocks go up forever. It doesn't mean they don't go into bubble cycles. It's none of that. But it's like, if you are to choose an asset in a highly correlated world, choose the best performing asset. Let's say you don't trade crypto. You're doing yourself a disservice if you don't own technology. And I can hear people now going, well, he's just a bubble. It's all a bubble.
Pal argues that in a world increasingly driven by technology, traditional investments in assets like gold are becoming less relevant. Instead, he champions the potential of blockchain and cryptocurrencies as global utilities akin to the internet. Blockchain's tokenized nature creates a behavioral incentive system that encourages network growth, leading to increased adoption and value. He likens this to past global utility networks like railways and road systems, but points out that unlike those, blockchain offers direct investment opportunities. He predicts that the market cap of cryptocurrencies, currently around $2.5 trillion, could soar to $100 trillion by 2032. Presenting an unparalleled wealth generation opportunity. Pal stresses the importance of recognizing this potential and strategically positioning oneself to benefit from it. He advises against taking excessive risks, suggesting a balanced approach to capture substantial gains without exposing oneself to unnecessary volatility.
What we've got here is a global utility, which is blockchain, much like the internet was. Now, unlike any of these global utility networks, trains, road systems, all of this, you couldn't invest in them. But because this is tokenized, you've got a behavioral incentive system to grow the network, which is the more people come onto the network, the more the number go up, the more people come on the network. And therefore, the more capital in the network, the more applications get built, the more the network gets used, right? It's fucking genius. And we've never seen anything like this, where we're all part of it. So here we've got this asset class, which is a globally homogenous asset, which doesn't exist. Gold is the only one, but gold, if you go to a village in India, the bid offer spread is 50%. Here we've got tradable on a mobile phone in India, the Philippines, Fiji, New York, Vancouver, the Cayman Islands, the same thing. And it happens to be the infrastructure layer to the internet for the system, for value and storage, and it's that distributed database, which is a public service utility good. Okay, brilliant. It's a $2.5 trillion market cap today. If we just extrapolate out the trend rate of growth, it gets to $100 trillion by about 2032. Okay, so this is the biggest wealth generating opportunity in all human history. So you've got this in front of you, which is this whole how to unfuck my future. Part of it is this. The other thing is don't fuck this up. Never get thrown off this horse, because this is the big one. This is the greatest macro gift of all time to get everybody out of this shit that they're in. So it's there in front of you. So then people are like, yeah, but what do I invest in? I'm like, okay, listen, detune all the noise. There's a bunch of decentralized businesses that sell block space. And they all have different types of block space. One's going, hey, mine's the most secure and the oldest. Somebody else is like, well, mine's the internet computer. And somebody's like, mine's the internet computer, but faster. They're just selling block space. So there's a bunch of companies selling block space or applications on top of that block space. That's all the space is. It's just a technology and it's an adoption. So our job within this is now not get philosophical and tribal about where do I invest in that technology and screw it up. Our job is to maximize the opportunity to the best we can. And that's a balance of how do you take risk? Because a lot of people go, max 10 risk. Like, no.
Yeah.
Look, if it's going for 2.5 trillion to 100 trillion, you don't need to take max risk. You can just capture the bulk and then do a bit of the tail on the side. Yeah, and look what happened to Amazon and Google and Facebook. I mean, it's all mid-curve. And I don't mean that as an insult. We've all been there. It's like once you simplify it all down, stop all of the monkey voices in your head. Filter out all of the noise from Twitter. It's like, is tomorrow more digital than today? Yes, no. If yes, continue. It's as simple as that. It's like the world is going to be more digital tomorrow. End of story. So even if you do have a bubble cycle and then a crash, what should you do? You should buy more technology. Why? Because tomorrow's more digital than today.
Well,
I mean, it's really, I've really got it down to the most ridiculously simple thesis. And it's embarrassing. I know it's embarrassing because people are like, this guy's a moron. I'm like, I've done, honestly, 35 years of work on this. I think I'm right, but we'll see. The Fed only operate on two things, unemployment and inflation. Both of those lag the business cycle itself. So unemployment, owner equivalent rent's part of CPI, which is the large part of it. All of that stuff lags by 15 to 18 months. So even where the ISM today is bottoming, that means that doesn't bottom until next year sometime, which is why the Fed are always cutting into the second year, because they're following the lagging indicators, the things that drive down CPI, which is why they're always late tightening. Unemployment, well, you're at the point in the cycle where unemployment ticks up. I don't expect a big tick up, but 4.5 through to maybe upside of 5% unemployment. Well, if you think of how lagging unemployment is, it's about 12 months lagged. So again, that keeps the Fed cutting, even though the business cycle is going to start gaining strength. So you'll have a weird world, and it happens at every single cycle, where the ISM's at 55 and the Fed is still cutting like crazy. And everyone's like, what the hell is going on?
Yeah.
It's because they just follow those two indicators and they're both lagging.
Mm-hmm.
And we live, in Global Macro Investor, Julian Battelle and myself, we live in the future by 9 months because we use financial conditions, and financial conditions lead the ISM, and it's been screaming higher for a while.
Pal's perspective extends to the broader macroeconomic environment, where he criticizes the Fed's reliance on lagging indicators like unemployment and owner equivalent rent in their decision-making. He explains that these indicators lag the actual business cycle, leading to delayed policy responses. As a result, the Fed often continues to cut rates even as the economy begins to strengthen, creating a disconnect between policy and economic reality. Al and his colleagues at Global Macro Investor focus on financial conditions, which they believe lead economic indicators like the ISM Manufacturing Index. By staying ahead of these trends, they aim to anticipate market movements and make informed investment decisions. Please like and subscribe my channel.